下面的一个话题是如何实现并购协同价值。那我们看得出，接下来的嘉宾是非常重视这个话题的，因为一共有2位演讲嘉宾，他们分别是国际并购整合联盟合伙人 Mr. Andrew Scola 以及出野成先生。那么，首先我们将有请 Mr. Andrew Scola。
Thank you very much. So I'm here from the UK, and I'm going to represent and be an advocate for investing and particularly M&A deals into the UK. And I'm going to talk to you today about synergies. My partner Makoto-san will join me to give to represent Japan, and he will be talking through some case studies, and I will go quite quickly through some of the theory of what synergies are and how to capture them. A little bit about my background. I come from a consulting background in the big firms PwC, Deloitte and IBM. I've worked with, and now I'm at Global Partners. I was one of the founding partners in GPMIP. I've worked in financial services, healthcare, and extensively in the tech sector. I rolled Apple out to Turkey. I led the separation of Skype out of eBay. And at the moment, I'm managing a $6 billion acquisition. So I think you probably already know that I'm going to say this, but the UK and Europe are really good places to buy companies. And my talk is going to be focused on synergies, but of course, as we said earlier, it's about deal rationale. And synergies essentially are about capturing that deal rationale in a quantitative way, making them real, that value that's added. So we can see here the chart of Chinese investment by country. It changes from year to year. Some of the mega deals that have happened skew this from one year to the next, from the UK to Switzerland to Italy in 2014, 2015. But every single year there is M&A deals from China to the UK. And what I'm going to talk about specifically is the UK here, but it applies to most of Europe and the Western markets as well. We've got desirable global brands. Okay, and we see this all the time. I was involved in the sale of Jaguar Land Rover to Tata in India. So we know there are lots and lots of desirable consumer brands. It's a consumer market. Okay, it's not Chinese in size. But there is a large and established consumer market. It's a stable economy. It's credited in the financial crisis as being well managed, well run, and very stable. It's got respected corporate laws and regulations. Many companies throughout the world operate under English law because of the respect for the English laws and in the English courts. And businesses are also very well governed in general, particularly large businesses and publicly listed businesses. And synergies are always achievable. So quantitative synergies are an intrinsic part of doing any deal. I repeat that, any deal. There are no deals done in the UK and in Europe and in the States as well, without quantitative metrics, normally out to the market of what those synergies are. So for those of you, we've talked about synergies, so I think most people probably know, but for those of you that don't know what I'm talking about when I say synergies, it's the financial benefits of an integrated company compared with how those two companies would be able to act independently. Okay, so it's the value that's added by being combined. And it's worth noting that you can't achieve synergies without making some changes. Otherwise, you can acquire and you can run another business, but you can't add any value if you make no changes. You don't have to fully integrate the businesses, but you have to make some, at least financial, tax, or legal changes. There are 4 basic types of synergy. Let me quickly review them for your benefit. The big one, and I think the one that's an overriding benefit to outbound Chinese M&A, is revenue synergy. This means growth. This means the opportunity that the combined business has to generate increased sales revenues. If there are no synergies stated, it's often implied that there are long-term growth synergies, and therefore this is normally at the heart of deal rationale. But in Europe and in the US as well, we try to quantify revenue synergies. The market will discount them, but our management teams will certainly try to quantify them. The second type of synergies are cost synergies. These are synergies involved in reducing the overall operating costs through consolidation and scale of the businesses. This is bread and butter for management consultants like ourselves doing business across borders or on any type of acquisition. There are 2 finance teams, there are 2 treasurers, there are 2 insurance policies. Almost always there are opportunities to integrate those teams, have process and system and people cost savings to reduce your operating costs. The third one is financial synergies. So this is better use of working capital and cash flows through establishment of financial synergies. And the last one is interrelated with cost synergies. It's called market synergies. And this means through normally larger scale, the ability to influence your marketplace. This means in customer contract or in supplier contracts, achieving better prices. Now, let me just talk very quickly through this graph. The proportions are not important, they are not to scale, but I want to just talk through the basic principles of this slide. At the start you see the pre-deal value of the target company. Let me come out and point. So on the left-hand side here is the pre-deal value of the target company. That's the market capitalization of all the shares issued, for example. The bit above it is the premium. So in order to get a deal approved by owners or shareholders, typically you'd have to pay a little bit more than the current market price, round up the price of the shares in order to get that deal safely approved by the shareholder group. So that's a slight premium. So that line going across the top is the purchase price. Now let me talk, and this is trying to quantify the value that you're adding. I think often, perhaps in Chinese deals, it's sometimes left unquantified, and we talk about long-term value, long-term strategic growth potential, and this is an attempt to try and quantify it. Certainly in Europe, there's a culture in M&A deals of being very specific about where you're going to get value. And the reason for that is to mitigate the risks that you don't achieve value, you don't achieve growth, you don't achieve your synergies, so we quantify them like this. You lose value in an integration, sometimes through lost opportunity, loss of management focus, loss of talent, loss of productivity after the deal. So you can expect a little bit of that. Then there's the cost of any integration decisions you make, the actual capital costs of any projects to integrate the businesses, to achieve the synergies that we're talking about in a second. So you have a company that's worth less than you paid for it unless you do something with it. And here on the right-hand side are synergies. So this green box on the right. All those things, the cost reduction and the growth, all of those synergies together that you need to identify, implement, and track, and if you've announced them to the market, to report out as well, or to your owners and shareholders. And the difference between the ultimate value you've created in the business after the achievement of those synergies and the purchase price is your net present value. So I've talked about the 4 different types of synergy. I want to quickly talk about 6 typical ways in which synergies are found. There are hundreds and hundreds of ways that synergies can be found, and these break down into a lot more detail. But just to give you an idea of some common areas where we achieve synergies. The first one is a cost synergy. It's back office consolidation. So this is finance teams, HR, legal teams, etc., IT, systems, people, and processes being consolidated and achieving cost savings. The second is a market synergy. It's around smarter procurement. Often overlooked, very important, but your supplier spend can be rationalized through greater scale. The third is supply chain. The opportunities for vertical or horizontal acquisitions to make cost savings in the supply chain through freight costs, through shared distribution, through shared channels is frankly enormous. And I've worked with Apple, who are the masters of supply chain optimization. So I can tell you a little bit about supply chain. The fourth one is new market entry. Again, a big one for outbound Chinese M&A is the opportunity to reach consumers that you before have not had an opportunity to sell your products to. And there are examples of Chinese companies buying purely for the sales relationships, for the market entry knowledge and legal entities to enter mature markets. Lastly is the fifth one is cross-selling, the ability to use your sales relationships to cross-sell products. And lastly is tax optimization. This has been a very hot topic in the United States for the last few years with tax inversion deals, where the 35% tax rate in America is legally avoided by acquiring smaller companies in jurisdictions like Ireland or Luxembourg, or frankly, almost anywhere in the world which has a lower corporate tax rate, in order to reduce your global tax burdens. Tax inversion deals are being clamped down on by the US government, but are still occurring. There was a new one announced this week. And there are other things that can be done as well in terms of legal entity structuring, intellectual property transfer, in order to optimize your tax. These are just 6 examples. There are many, many more. Lastly, I wanted to bring the point about synergies back to the broader case for deal rationale. And deal rationale is simply why you're doing deals. Why should you be doing deals? Are you clear about it? And are you quantifying it? And again, the one message is that in Europe, there's a culture of clarifying and quantifying synergies very, very, very carefully. Here are some of the top reasons for doing Chinese outbound M&A, in my opinion, and just a few examples, Lenovo, Geely, and others, where I believe some of these reasons, most of which are synergy related, were the key factors in some of those deals. And I've talked about some of them already, so I'll just go very quickly through them. Rapid entry into established markets, we've talked about that. The acquisition of advanced technology, alludes to Thomas's point. Customer acquisition, okay? So it's not just consumer, it's also B2B customers. Foreign natural resources, this is an obvious one, assets all around the world. Market diversification in a stock market, in a currency which is fluctuating, it's a risk mitigation to acquire companies and assets in more stable economies. Access to IP, I think I've already talked about that. Labour cost savings by repatriating jobs. It's not going to be popular with foreign governments. It's not something that you would overtly want to communicate, but it is an obvious and unavoidable long-term option for outbound Chinese acquirers to bring some of those jobs and some of that production onshore. Utilizing foreign capital reserves, talent acquisition, R&D, and the last one of my favorite, is acquiring good brands. Okay, I'm going to pass over to Makoto-san now. That's some of the theory. If anyone would like to come and talk to me over dinner or at any time about synergies, technology, any of the companies I've worked for, or acquiring or doing business in the UK, please come and see me. My name's Andrew Scola. Thank you.